or you can sell common, like you said, but you're buying Bitcoin. You know, when you sell that STRC, you're taking that cash. He's taking that cash, and he's by and large, he's buying Bitcoin, putting that on the balance sheet. So now you've got an asset on your balance sheet that has been appreciating. You know, not short term. I'm talking long term here. It's been appreciating north of 30% a year since COVID, right? So now you've got this asset that you've got $66 billion or more now of an asset that is appreciating. Now take everything apart.
If you found this helpful, please like, subscribe, and turn on notifications for more insights into the digital asset space. Your support boosts the algorithm and helps this channel grow immensely. Drop your thoughts in the comments below. Thanks for watching and enjoy the rest of the video. Let's start with the instrument at the center of the strategy. STRC, a perpetual preferred security paying an 11.5% dividend. Now, for many investors, that number alone raises eyebrows, but Lavish walks us through exactly how it works. When Saylor sells STRC, he takes that incoming cash and by and large buys Bitcoin directly onto the balance sheet. So you're not just buying a high-yield instrument, you're effectively gaining exposure to a machine that is systematically accumulating Bitcoin. And here's where the math gets interesting. MicroStrategy currently holds roughly $66 billion worth of Bitcoin on its balance sheet. Meanwhile, the total liability obligations across all of its preferred instruments sits at approximately $1.488 billion, or about 2% of that Bitcoin stack. Lavish's point is almost elegant in its simplicity. If Bitcoin appreciates just 2% on average annually over the next decade, Saylor doesn't need to sell a single Bitcoin to service that debt. Not one. That's the foundation of the entire thesis.
So first of all, STRC, you know, he sells the STRC and he's paying 11.5% dividend on it. So you could either put aside some of the cash that you get STRC as it comes over par, and you can put aside some of that cash, or you can sell common, like you said, but you're buying Bitcoin. You know, when you sell that STRC, you're taking that cash. He's taking that cash, and he's by and large, he's buying Bitcoin, putting that on the balance sheet. So now you've got an asset on your balance sheet that has been appreciating. You know, not short term. I'm talking long term here. It's been appreciating north of 30% a year since COVID, right? So now you've got this asset that you've got $66 billion or more now of an asset that is appreciating. Now take everything apart, and his obligation to those underlying liabilities for all of his preferreds is currently at, let's see it's $1.5 billion, 1.488. So it's roughly 2% of that stack of $66 billion. So if Bitcoin just appreciates 2% on average over the course of, you know, so let's call it the next 10 years, then he doesn't have to sell a Bitcoin to service that debt. Now he could sell some of the Bitcoin to take down some of the converts. He could use some of the sales of stretch to pay down some of the converts. And all of that is accretive to the common underlying. So look, I have this conversation with other people who come from my old world, like you did too, in the institutional world. That it's just a different level of conviction. I have a higher level, and so and I know Michael and his team, and I sit on the board of Strive Asset Management. We're doing something similar on a very small scale. And I do think it's an important distinction to make, though. These things, Stretch is not a money market. I wrote a whole piece about it this weekend. It's not a money market, but you're getting paid 11.5% for taking that the risk that you defined, which is that Bitcoin, like you're literally just taking the bet that Bitcoin's going to not go to $5,000, and you're going to be paid these. I think Saylor's accumulation has been, I think that does give some institutional investors pause for sure. But let's pull apart a bunch of threads here. So number one, Bitcoin's been seen as a risk asset for years here. It's been like the tip of the risk spear, so to speak, for a while. You could argue that it's broken out from that and it's not really correlated to anything, but the reality is it does move around with the NASDAQ quite a bit. And so this last drawdown from all-time highs down to $60,000 or 62, whatever it was when it touched bottom here, this last go around has been, it happened all before the war, and then the drawdown again in gold and silver. So it's kind of like this hot ball of money is moving around between assets, and Bitcoin had benefit from it. I think it got ahead of itself, but then again, you had the same thing with gold and silver. So that hot ball of money does move around. It's definitely in the AI names now. As far as Saylor's concerned, I too have worked on this balance sheet quite a bit, and I'm not nearly as concerned about it as Doomberg is, and probably because I have a higher degree of confidence in Bitcoin as a long-term asset. That's likely the underpinning difference here, is that I just have a much higher conviction in Bitcoin as an asset, as a long-term store of value. The big convert he's got coming up, the next convert he's got coming up is in 2028 for $1 billion. I mean, it's nothing. It's 1 billion out of the $66 billion of Bitcoin he's got on his balance sheet. At the end of the call, I was actually on the call as one of the analysts asking questions, and I asked him, I said, look, you're talking about the fact that you might sell Bitcoin. What do you think and we've got this new perpetual preferred instrument that has been wildly successful here. What is the optimal structure of your balance sheet? And he answered, and would you be selling off and retiring a bunch of this debt and some of these other preferreds that are just not the core focus? Because the core focus right now is clearly Stretch, STRC, and MSTR, the underlying common. And his answer was he's not going to retire the press because he spent like $1 billion bringing those to market. He's going to retain that optionality. That makes sense. He doesn't have to retire them. There's no reason for him to. He doesn't have to pay them off. But the converts, he wants to retire, and he said he wants to retire those in time, and he's got and they're putting plans around that. So you've got $1 billion that comes due in 2028. That's a short putt here, in my opinion. And then the same thing in 2029, you've got $3 billion. That's his big one. Is he going to refinance that? No, he's going to pay that down. So he's got years to deal with that. And he's got years to build up the cash reserve to deal with it, or just start retiring them, piece by piece. So I'm not as concerned about that at all. Do I think he would startle the market by selling a bunch of Bitcoin in order to do those things? Well, think about it. It's accretive to the underlying shareholders when you're pulling down the enterprise value of the company. And so that's a good thing. The second thing is it gets him closer to having an actual rating that he can point to for the S&P inclusion, because he's big enough. It's just the S&P is basically the credit agencies. They just consider Bitcoin. They don't consider it an asset. They basically mark it to zero. So that doesn't help him. So, but that gets him closer to that kind of hurdle he's got to get over. And so I'm much more confident in his structure. But I'm a lot more probably, I don't know, Doomberg, just how much work you've done on it, but sure. I've done quite a bit of work on it.
So I wrote a whole... Lavish then shifts gears to address a question that comes up constantly: Bitcoin's energy use. His answer reframes the entire debate. Bitcoin mining, he argues, doesn't create new energy demand in densely populated areas. It seeks out the cheapest, most stranded energy available, often energy that would otherwise be wasted entirely. He cites natural gas flaring as a prime example. When oil fields are drilled, associated natural gas often comes up with no pipeline infrastructure to deliver it anywhere useful, so it's simply burned off. Bitcoin miners can monetize that waste. His own Bitcoin Opportunity Fund has invested in a company called Corman, which taps into roughly 6 gigawatts of stranded renewable energy in West Texas energy that was never connected to the grid because no pipeline was built to carry it east. That energy now powers Bitcoin mining. And increasingly, these same miners are pivoting their infrastructure toward AI hyperscalers and data centers, which is where demand is heading next.
Just for the listeners really quickly, because you're hearing what Doomberg said about natural gas, and we're probably wondering what he meant. If some of you, what he's saying is that the natural gas, when you drill for oil, and especially when you frack for it, when you break up the ground to frack for it, you get what's called associated natural gas, and associated natural gas comes up with that oil. And often you're out in a field that you've got no way to get it back to a productive area, a city or a town that would actually use it. So they just flare it. So when you're driving by these oil fields, you see the flame on the top of a pipe. That's just them. They're just burning off natural gas because they can't do anything with it. It's too cheap to move it across in trucks or even. You're never going to build a pipeline unless you have a lot of different fields that you can connect together to get into a metropolitan area. So we just have a glut of it. It's everywhere. And the shale, the revolution really.
And so this is why,
but to answer your question, Nathan, about Bitcoin mining, just really quickly, like Bitcoin just searches for the cheapest energy. That's what it does. Bitcoin miners, they need the cheapest energy. They're not out there ramping up energy demand and plopping down in metropolitan areas. They're off grid. They're away from the center. Very often they're behind the fence. So it's a different equation for them. And so when people say, oh, they're going to boil the oceans, of course they're not. They're just going to use the energy that's being wasted. It's in an area that can't be used. One of our biggest investments at the Bitcoin Opportunity Fund that I co-manage, is this company called Corman, and Jamie McCavity out there. There's 6 gigawatts of stranded renewable energy out there that they didn't build a pipeline across Texas to get it east. So it's just stranded out there, and we're able to use that for Bitcoin mining. And now he's been pivoting toward the hyperscalers and and AI data centers, because that's where the demand is. But so it's just a different equation than the AI data centers. But those, obviously, the Bitcoin mining companies that have these long-term, long-standing contracts to pull this energy, they're pivoting because it makes financial sense, clearly, and that's what you've been seeing in the activity in those names. So the converts, well, I mean, look, it depends on which convert you're talking about. Some of them are in the money, they'll just convert over to equity for sure. But they've got a total of $8.2 billion of converts, and they mature anywhere from 28 to 32. Okay, so let's just talk about capital structure. So, in a company, you've got the claims on assets, like we've been talking about. And so for the listeners, the highest claim on asset is basically, it's pretty much bank debt. If you get a line of credit with a bank, you got to pay that back before you're paying anything. And then you've got senior secured, senior subordinate, subordinate unsecured, and then you just go down the ladder. Anything that's a bond is up there. And if it's secured, that means that bond has a secure on a certain asset. It could be the buildings, it could be, it could be some of the technology or patents, whatever it is, that it's secured to something, and you have claims on those assets. When you have a liquidation, you're going to you go through a Chapter 7 bankruptcy where you're just going to liquidate it all and give the holders of everything. It goes all the way down the line. You got to pay everybody off all the way down. It's going down to the converts. So you have all those bonds down to the converts, then the preferreds, and then the common. And typically the common is typically going to get a few pennies on the dollar. If you have a bankruptcy, there's not going to be anything left for them. So that's just kind of the way it works. If you liquidated the company now, there would be plenty of claim for the common, but they're not going to do that. So I think that we resolve the war issue, and that Trump gets his face-saving victory, whatever that may be. And I happen to believe that we're not going to crash. This K-shaped economy is real, and it's just going to keep going for a while. I don't know how long, but I think we haven't. I'm not one of those guys that's calling for the market to just fall apart here. So and caveat, even if it did, we know what happens. There's the Fed and the Treasury are absolutely trapped by Congress. They have no choice but to print more money. It's an obvious outcome. They printed $5 trillion in 21 to 23. They're going to print a multiple of that next time around. If we have a black swan, which, I've been in this business for 30 years and I've seen, I think, 700-year events, so there's another one coming at some point. I don't know when. And when it does, they're going to print massive amounts of money. And what's going to benefit from that? Assets that can't be, debased. Things like gold, silver, Bitcoin, like they're gonna just absolutely rip. And of course, stocks will too. Companies that can't just be copied. Things like the Mag 7, and then when Anthropic and OpenAI and all those come to market, and SpaceX, they'll benefit from the money printing. Meaning, just to make this absolutely abundantly clear, that they're going to reflect a mirror image of what has been debased against it. That's what's happening, and that will happen. All right, so to answer your question though, end of year, we're bumping up against or above the all-time high again. And that's what I expect for Bitcoin.
Zooming out, Lavish addresses the macro environment with the candor of someone who's navigated institutional markets for 3 decades. He acknowledges Bitcoin's correlation with the Nasdaq. It does move with risk assets, and the recent drawdown from all-time highs to around $60,000 reflected that. But he also points to something more interesting: the behavior of what he calls the hot ball of money capital that rotates rapidly between gold, silver, Bitcoin, and AI-adjacent equities depending on risk appetite. His year-end Bitcoin call, back to or above all-time highs. And over a longer horizon, he makes the structural argument that we are in a K-shaped economy that will persist, and that any black swan event severe enough to rattle markets will trigger another wave of fiscal and monetary expansion. The response to that printing will be, as it has historically been, a repricing of assets that cannot be debased. Gold, silver, Bitcoin, and select equities like the Magnificent Seven, and eventual public offerings from companies like Anthropic, OpenAI, and SpaceX.